Over the past few weeks, the world has reminded us of something that retirees cannot afford to forget. The global economy can change overnight. We've got war tensions in the Middle East, they're escalating. We've got oil prices that have surged to over $100 a barrel. I don't remember the last time that happened. Inflation fears are surfacing, markets are reacting. But for retirees, and if you're out there approaching retirement, the question isn't just what will the markets do next? The real question is your retirement structure prepared for the unexpected? Because retirement planning today, it's not just about returns, it's about resilience, it's about coordination, and most importantly, it's about what we call it wealth care, the $2.6 million retirement mistake. And that's the silent erosion that occurs in a retirement plan when it's fragmented instead of coordinated. Today, we're going to unpack why these current world events are mattering to you, the retirees and soon to be retirees, why traditional retirement planning often falls short, and how coordinated wealth engineering can dramatically improve your outcomes. And if you'd like to see your own coordinated elite wealth plan, what it might do for you, give us a call today at 888-888-5601. That's 888-888-5601, or visit us at discoverunlock.com.
Awesome. Well, Bruce, great to be here with you. Listeners, viewers, great to see you. I'm your co-host, Tony Shore. And of course, our host, the man with the plan, is Bruce Smith. And Bruce, this sounds like a great topic. You've lined up a good one. And I know you've been busy. You work hard at these things. You and the team there at WealthCare, so good at this. You've been doing this a long time, helping people. But I find this interesting because there is, markets, the war, is inflation going to creep back up? Obviously, we've seen the start of that. Like you said, it's been a long time since we've had gas prices like this, or at least the gas costs going up to over $100 a barrel. I don't think the market liked that too well. So we'll see. I mean, the market always rebounds eventually. At least it has over the last 100 years. So that's good. But in the meantime, I know people get concerned, and we don't want people making financial decisions based on their emotions, do we?
Absolutely not. Yeah, I mean, emotion is not where it's at. But by the same token, you don't want to base your planning on a thumb rule. I mean, the biggest flaw that exists in the financial world, like if your goal is to maximize the lifetime benefits, so we're talking 20 to 30 years, you've got the nest egg, you've saved for retirement, you're there, you've got this money, you know, 95+%. Actually, I just saw a statistic. It says less than 1 out of 10 retirees have actually seen or ever had a discussion about a coordinated retirement plan that it not only does it address the key areas of risk and taxes and income and legacy planning, but where they're actually truly coordinated and are actually working together. What normally happens is, you have a tax preparer, you've got an attorney you met with once to do your will. As far as legacy, income planning, it's the 4% rule, or maybe you have an annuity or something, and you have an investment person. But 95+% of this industry and of the consumers out there listening believe that their retirement success is tied to one thing, and that is portfolio results. How my investments do. I have this nest egg and I'm watching it go up or go down, certainly down lately. Um, you know, it's just you're looking in the wrong place. You need a better pair of glasses. You need a wider vision, and say, and we're always going to beat on poor Ben Franklin. I saw a thing this week, by the way. It had Albert Einstein playing a guitar, and it was Al Einstein, which I thought was pretty funny. So I thought you'd get it. He had his hair blown out in psychedelic colors. It was pretty funny.
That's hilarious. Al Einstein.
But Ben Franklin is so big on, a penny saved is a penny earned. And today,
Sure.
We said last week on the show, I think, wealth care's phrase should be $100,000 saved is $100,000 earned. And, is we talked about wealth leakage last week, and how, you can have a lot of holes in your retirement bucket, and you don't realize that money is leaking out in the form of unnecessary taxes or unnecessary market losses, like people are probably seeing in their portfolio. That not everybody has that portfolio that's going down. So, the financial industry is big on portfolio management. We're big on actually having a total structure that is addressing all four, and they're all integrated. They're all geared together and working together, always to maximize your wealth. And I think that really comes home when you have the volatility and the issues we're seeing globally and in our domestic markets.
Yeah. And speaking of that, let's talk about, Bruce, I wanted to ask you about why world events matter more in retirement.
Well, we live in a global economy, and
Sure.
and there's two things. I think there's the global economy, but I think an even bigger element is global information. Is that for the bulk of our life, as we were growing up, you didn't hear what was going on in India or Belarus or somewhere, and now it's like, every little event is documented somewhere and somebody's talking about it, and that's, because being well, I don't know whether you're aware of this. Are you aware that a submarine actually sank an Iranian ship? Did you know that? I don't hear you.
Oh, sorry. I wasn't aware that it was a submarine. I mean, I heard we
Well,
sank a ship.
we've sunk, I think we've sunk 50 some ships now, but
Yeah.
the one ship they sunk in international waters, was sunk by a submarine
Oh,
with
I
a
did not know
torpedo.
that.
That was the
Wow.
first torpedo, launched and used, to destroy a ship since the Second World War, as far as
Wow.
America. And of course, I was on submarines. We
Yeah.
trained. We had the Mark 48, which is the torpedo they used. It's a very interesting weapon. It doesn't hit the ship. It actually goes under the ship and explodes and breaks the keel. But but the submarine commander, the CO, he notified the Iranian ship, and he said, let your people abandon ship because we're going to sink you. I mean, he gave them warning, and the Iranian captain's like, absolutely not. You leave this ship, we'll shoot you as you try to get off the side and all that. But we're doing things, and everybody says, why are we doing this? Well, first of all, you know, all these armchair experts, is the same thing as armchair experts when it comes to finance. Is you've got to have all the facts, and you've got to have a wider scope. Interestingly, a lot of this has to do with China, not Iran. And I think if you look through and understand, because there's a lot of things that have happened with Iran and with China. So I mean, we're taking actions, but every little thing that happens now makes the news cycle. It
Yes.
makes, it's information, and we all, and God knows we're all getting overloaded on Facebook, on here, on there. And I'm not here to be pro-war or anti-war. I mean, we're not having that discussion. But the discussion really is that we as an information society are making so many decisions. What you just said, don't make decisions based on emotion.
Right.
You have to almost divorce your emotion and look at things factually. And I think in finance today, more than ever, you've got to kind of have a crystal ball, and a crystal ball from the aspect of saying, what do I know for sure with regard to my finances? If this happens, something positive happens in the market, where do I stand if things are negative happening? And we've said it a million times on the show. We'll say it a million times more in future shows. You know, Warren Buffett, I think, has the best advice in that arena. He says, he said, you can look at your return, and that's a fair and equitable measure, but a
Mhm.
better measure is risk adjusted return. So if you're looking at that portfolio, and his advice is, if your portfolio has more upside than downside potential, that will work about perfectly in helping your returns. His words. That's a quote from Buffett. So you've got to ask yourself, what does my portfolio do on an upside? What does it do on the downside? And
Mhm.
now I think we're facing downside. And what's the severity of the downside? What's the longevity of the downside? We don't know that. But interestingly, like the portfolios that we build, and we get more calls about this than we do anything else, is when something happens crazy in the market, clients will call and say, I just wanted to verify something. So these assets that we have, I didn't lose anything, or I've lost very little, and you're affirming that, and people. Well, we sit down with new people, and we said, we'd like to take 60% of your portfolio and build in some form of wealth protection or wealth preservation, and they're like, what are you talking about? I didn't know you could do that.
Hmm.
So you take unknowns, 100% unknown. If you have a 60-40 stock bond portfolio, you have a 100% unknown portfolio. You can't tell me a year from now what's going to be up, what's going to be down, to what degree, none of that.
Nobody
But
has a crystal ball.
if you have an asset, and the wealthy people have used these for years, decades, almost probably centuries, is if I know it for a fact this can't go down, then okay. And the majority of my assets are in things that either won't go down or are limited in going down. We actually honor what Warren Buffett said. Now I know in advance all these things happening. People can look at their portfolio and say, "Hey, I didn't use. We don't use bonds traditionally. We use other alternatives instead of bonds, but we put wealth protection, wealth preservation at the front, and we find that when this is happening, those portfolios, those assets, hundreds of millions of dollars of our clients' monies are not moving in a downward direction. So it
Yeah.
really makes the game smart. But I think it's the global information, global events, and the global information chain that is driving the velocity of markets in ways that we've never seen before.
And that's why, because it's more of that global climate and the things you're talking about there, that does affect retirees more. World events matter more. But things like oil going over $100, that affects retirees because energy costs drive inflation, right? And then inflation pressure affects retirees the most because they're on
Absolutely.
a fixed budget, right?
Yeah, I mean, it's people. We've talked many times on the show, and I know you have in many circles about sequence of returns.
Yeah.
I can't tell you. I mean, it's funny. Things have been good for the last several years in the markets and in
Oh,
portfolios,
yeah. Things have been
and
great.
people, they'll tell you my average return's been 8.5%, 10%, whatever it's been, and
Yeah.
they hang their hat on that. And it's like, okay, but average return is not something. It'll get you through the accumulation years. And this is the key element that people miss, is that they keep looking at their retirement nest egg and the management of their retirement nest egg and their retirement planning as if they were still working. They're like, oh,
Based
hey,
on an average return.
well, not just an average return, but it's basically, hey, I spent 40 years building this nest egg, and I've been through the ups and I've been through the downs, and it's been really wonderful. Okay, let's unwrap that for a moment and let's focus on that. So, number one, when things went south, you were still putting money in. So you were adding to it to help rebuild the account through
Right.
deposits, not growth. Your employer was likely adding money to that account, helping it rebuild, not due to the growth speed of it. Okay. In retirement, you don't have your contributions to help rebuild. You don't have the employer helping rebuild, and you are taking money out. So now the market goes down, you lose a portion of that nest egg, you remove even more capital from the nest egg that will not be there to grow and rebuild. So it is a totally different approach, and people don't understand. That's really why coordination of all of the planning elements available to you, smarter tax management. Most people have no tax management, smarter tax management, legacy planning, income planning. We budget and we plan for preferably an increase in income every 2 years for our clients. That's our goal. And with that goal, if you're going to have that kind of a goal, you got to be a little tighter on your risk management because you don't want the portfolio going the other direction. So, coordinated planning is something very few people have seen, but it's really been the hallmark of what we've been doing since 96.
Yeah.
God, that's a long time.
It is a long time.
Ooh, wow.
Yeah. Well, and so we've talked about oil prices, geopolitical instability in the Middle East, which has come and gone as long as I've been alive, and a long time before that. And then now you're talking about market volatility, sequence risk during withdrawals in retirement. That's huge.
Yep.
Just how sequencing of input, dollar cost averaging helps you on the front end. The withdrawal schedule hurts you on the back end, or can. And so that's what you're talking about there. I think that's really important. So let's that's part of that retirement return illusion, isn't it? I mean, portfolio performance alone isn't going to be enough.
No, absolutely not. And we've said this many times. I'm saying that a lot. We've done this. We've done radio now. I think it's 23 years.
Yeah, you've done it a
These
long
numbers,
time.
these numbers are getting big in the wrong direction for the wrong reason.
Right. That's the
It's
problem.
it's that date of birth thing on my driver's license, but that's the retirees. We all go through it.
Sure.
But yeah, I mean, if you look at the elements of how things really function in the real world, you typically don't see people or talk to people necessarily whose retirement is failing or has failed. I have seen firsthand people who we did plans for, and they did not follow the plan, and they gave us all the reasons in the world. But at the end of the day, it's their money. I always remember one wonderful client. He's now no longer with us, but man, I really loved working with him and his wife. And he retired from Walmart. He had a nice 401k. The planning looked solid. Everything was great. And yes, there was retirement income coming out. But then I get a phone call. Hey, we need to take out 5 figures for his daughter's wedding. Well, you never get between a mama bear and her daughter when it comes to a wedding.
Right. That's
So I
true.
say, well, to take this out, here's the tax impact. Okay. Well, then a pregnancy occurred, and 2 years later, I need another 5-figure number lump sum out for a minivan, so we can haul the grandkid around and do all this, and all these things sound great. But the fact is, like, our planning said X, and you're spending 3 times X. When you
Yeah,
add up
that's
all the
not
other
good.
things. And we watched that person go to where they depleted their nest egg, not that they didn't get life enjoyment and things out of it, but they depleted their nest egg and lived on Social Security only. It's not a pretty sight, so but guess what? You're never gonna go to that person. They're not gonna tell you, "Hey, let me tell you about my retirement blowing up." They wouldn't do that,
Right.
because chances are you're not gonna talk to them. You know why? Because they're not out in public. They're not traveling. You're not gonna hear about their trips to Disney World.
No.
So retirement failures do occur, and the most dangerous is somebody recently retired.
Mhm.
They built this nest egg, and it's like, okay, here's my plan. I'm gonna rely on these numbers. And then you see 15, 20, 30% of it slip away. And if you're taking income from there, there's a good chance it will never rebuild and get back to where it once was, which was that number you based your planning on. So you've got to adjust your lifestyle or continue the spiral of depleting assets. So now more than ever, if you're sitting out there and you've been riding the wave of the market, which is great, this is a time to kind of come down to reality and say, well, okay, how fragile is my retirement? Or more importantly, what can I be doing, not just on the risk side, but what can I be doing on the tax side to send less money to Uncle Sam so I can have more money to offset losses that have occurred, more money to provide for that income? Do you have an income plan? Have you set up a plan that says, look, if the market does good, I get a pay raise because things are going to cost more with inflation. So you see how all these gears fit together, and it's basically a flywheel effect where it's turning all the time, and you're hitting on all the cylinders. You're basically over here with risk, and then taxes and income and legacy, but it's always addressing all of them instead of being fragmented, where you've got no tax plan. All you have is a tax preparer. You have no legacy plan because all you have is a will. You have no income plan. You're just taking a 4% withdrawal. What are you doing? You're watching the portfolio. There's a better way, and give us a call, 888-888-5601. It starts with a simple conversation, a 20-minute discovery call. Talk to myself, my son Bruce, Chris. Um, we want to talk about your situation, and is there an opportunity, to be able to extract greater value over your retirement lifetime? And if you wish, go to discoverunlock.com. You can answer a few questions there that really kind of helps pre-populate the call, so we know we're hitting all the right topics for you. We want to be very efficient in our call with you, give you maximum value. So discoverunlock.com, or give us a call at 888-888-5601.
That
Tony's
sounds
favorite number.
Yeah, you can never have too many eights. I always say that, Bruce. And Bruce, it's funny. I just want to go back to one thing you were saying there earlier, and I think just to clarify this point, I think that I don't want people to miss this. I mean, those first 5 to 10 years of retirement, that's, can be the fragile zone where early losses with too many withdrawals. You gave a great example. Take 5,000 out for this, 10,000 out for that. That can really damage your portfolio. And that's basically sequence of returns risk. If you're withdrawing not only too much, but even if you're withdrawing regular at the wrong time, like where it's coming out from, that's why you have a balanced view. It's not all in the market. Your money for your monthly expenses maybe isn't all attached to the market, right?
Yeah, I mean, and we always say we're going to be very honest with you. I mean, I have no reason to be otherwise
Sure.
with people, and I'm to the point in my life where I don't have time for it. I'm just going to give you the
Sure.
fact. You may like them, you may not, but I can tell you right now. You talk about divorcing emotion when it comes to your money. I mean, think about this, and there's somebody out there listening that this is happening to. Make no mistake. You know, they planned a cruise, or they planned to take the grandkids to Disney, or they planned whatever, a significant expenditure.
Sure.
There is nobody out there that is watching their portfolio drop and saying, "Oh, well, you know what? We probably shouldn't take that trip to Disney. We shouldn't take that." It's
Right.
not going to happen, but you've got to be realistic and say, "Okay, we put a dent in our retirement, and the market put a dent in our retirement. Are we on the right path? Or is it time to look at, maybe a higher level of planning to say, where else can we find extra shekels, not just in what we're earning in our investments or losing, depending on the market, but
Yeah,
are there
right.
other places we can save money? I don't mean take income and savings. I'm talking about reduce the tax burden, reduce other elements to maximize your wealth. That's the biggie.
Yeah, that's a huge one. And now, before we take our first break here, I want to talk about those out there. I'm sure we have listeners wondering whether their retirement structure is prepared for market volatility, inflation, these types of shocks, or geopolitical, disruptions like we've seen. Your team can help them, right? So you're offering a 20-minute elite wealth discovery call. There's no charge, no obligation. I think that's fantastic. So I'm going to give that number a couple more times to make sure our listeners and viewers get it. It's 888-888-5601. Again, that's 888-888-5601. And Bruce, I know you love to hear from people, right? That's what you do, is talk to people and help them, right?
I mean, I love to hear from people even more than Tony likes saying that number.
I probably a lot more. No, I don't mind saying the number. That's great. Well, we're going to be right back with more of Unlock Your Retirement and our host, Bruce Smith, right after this. All right, now on to segment 3. Okay, the coordinated wealth effect. How about we jump into that? Is that about where we're at? Yep.
Yeah.
Or we can do.
I have no idea. I'm making it up.
Retirement return illusion. I don't know if we've covered that. Okay. Okay. Or we can do the retirement return illusion. Why portfolio performance alone is not enough. We talked about that a little bit. Average returns, illustrative example of $1 million portfolio. Okay. All right, here we go. Hang on. I will bring us in for the second segment. How about that?
Yep.
Or the next segment. Here we go. Welcome back to Unlock Your Retirement. I'm your co-host, Tony Shore. I'm here with our host, Bruce Smith. Bruce, we're talking about a lot today. We're talking about markets, war, inflation, and why retirement structure matters now more than ever. You touched on some great reasons and some great points. And I think this is good. Obviously, we haven't touched on a few things that always seem to affect it. And that's, we've talked a lot about taxes on past shows. But that can really contribute to that retirement return illusion that people have, right? They think, oh, I'm going to be able to take 5%, whatever, out of my, portfolios and not have to worry about it. But there are things that affect that too, aren't there?
Oh, there is. I mean, one thing we hear, with the advent of electric vehicles, probably the most asked question is, how far can you go before I have to recharge it? I think,
Right,
I mean,
exactly.
and it's funny. I read this one article. Somebody rented a Tesla in, I don't know, Mississippi, Louisiana, somewhere. I think it was New Orleans, and they were going to Chicago, and they
Oh,
and
wow.
they kind of chronicled the whole trip of what it was to drive an electric car from New Orleans to Chicago.
Wow.
Um, and it was very interesting. It wasn't what we think it would be. I mean, you have to budget your time, and you're going to pull over, and you're going to be somewhere for 30 or 40 minutes while it recharges and all that. So, but the key thing is, what are we really talking about? We're talking about efficiency.
Mm-hmm.
How efficient is that vehicle?
Mm-hmm.
Of course, now with gas prices, how efficient, how many miles per gallon is that vehicle getting? If you're driving to work every day, 5 days a week, and you're putting gas in the gas tank, I mean, more of that money is going into your gas tank than it was going into your refrigerator, so that's a big deal. Retirement is a huge machine. It's a huge set of decisions because you're talking about nest egg. And when you talk about efficiencies, you know, portfolio management alone is a grotesque inefficiency, because number one, no matter what you do, it's an unknown. I mean, I think we can all agree on that. We can't predict the markets. We can't predict what's going to happen. So we're dealing with an unknown. And if that's all we're focusing on, then it is incredibly inefficient because what you're doing is you're ignoring other important aspects, basically things that are costing you money. So at the beginning of the show, we talked about, and this one, I've had this discussion with a number of people when we meet face to face, and we talk about 30 years of retirement. Somebody who's 60 retires, and we project out to age 90 when we build our plan. And sometimes we see not hundreds of thousands of dollars, but millions of dollars
Mm.
in difference by having a coordinated strategy that's looking everywhere and trying to be as super efficient as possible with the wealth that they've accumulated. So, if you have a $1 million portfolio, so you have 401ks, IRAs, and everything, you add them all up in your household, and you go, okay, we've worked and we have $1 million. And I think we've said before on the show, wow, $1 million used to be a big number.
Yeah.
Nowadays, we see it all the time. I mean, it's if you don't have $1 million saved, you're probably hurting, and whoever thought
Right.
you'd tell you that, these are
Yeah.
incredible times. But a $1 million portfolio, if you take into account not this year tax bill, but the tax drag alone on that money over a 30-year period, if you look at the sequence of return errors, how you assessed your risk, and we've seen people take more risk. I would say 80% of the time when we sit down with somebody, we find that when we assess their risk tolerance and bounce it against their risk exposure in their portfolio, over 80% of the time, we find that they are overexposed risk-wise compared to what they've said they're comfortable with. Now, everybody ignores that when the market's good, but it really slaps you when the market is volatile and going down.
Sure.
Um, Roth conversions, when did you do Roth conversions? Do they make sense? Is there a tactical way to do it? We have some people that got angry about taxes and said, I'm just going to do it one time and do it all. If it cost me a couple hundred grand, so be it. and you show them, hey, that's very poorly timed. That's not what you should have done. Here's a better strategy you could have followed. Or we have people that come to us and said, I hear you talking about taxes all the time. We've kind of made a decision. We're going to do a Roth conversion, and here's how we're going to do it. But we wanted to get your second opinion. It's like, okay, so we run our analysis and I show them, "Oh, here's a better way. This will cost you even less money in taxes, and you'll still get the benefit of a full conversion over this time period as opposed to doing it in a lump sum." That's incredible value. If you needed surgery or you had a serious health issue, this is not about having a bad advisor. You can have an incredibly competent advisor. You can have an incredibly competent tax person, an incredibly competent attorney, doing all of these things, but they don't talk to each other. They don't know
Right.
what one or the other is doing. So, wouldn't you get a second opinion? And that's that. So a lot of people come to us not with the intent of changing advisors, but they're like, I want to make sure that I am being coordinated in what I'm doing. And like I say, with the most recent data, that less than 1 in 10 of all retirees have ever seen or ever discussed a coordinated plan. It's
Hmm.
typically reserved for the very wealthy or for people that just happen to have like a referral to a top level advisor. So you have tax inefficiencies, you have asset location mistakes. So what type of assets are you in? I don't know if you saw this week, and I haven't done a lot of deep dive into it, but BlackRock, there were liquidations occurring in BlackRock. Did you see that?
Uh,
They stopped them.
right.
They basically just said, "Nope, no more money's going out." And I'm kinda like, "Wait a second. Those people, that's their money, and you
Yeah.
allowed liquidations up to a point, and you just arbitrarily cut it off?"
Hmm.
I mean, I that one, I have to do a little deeper dive. Maybe we'll talk about that in a future show, but, what is it you do know and don't know about, the opportunities that you're involved in?
Yeah.
That one's scary. That one really got me. It's like, are they just saying, "We're so big and we don't care?" And, I sure hope not. But I mean, if it's allowed by their prospectus and, it's something you signed up for and you have no idea that that can occur.
Hmm.
Medicare is an inefficiency. If you don't plan the taxes, you end up with RMDs that quite often can escalate you into a higher tax bracket, paying more taxes unnecessarily and paying higher Medicare costs because of tripping, Aunt Irma, as you like to say. So Uncle Sam and Aunt Irma are incredible gross inefficiencies. And
Yeah.
then, fragmented planning across advisors is that, all of these areas are areas where you can save money if you have an advisory team, an elite wealth advisory team that understands where to look, have the tools to identify it, have the strategy to fix it and minimize it or eliminate it when possible to keep more money in your portfolio. So in the case of the example we talked about, a couple 60 years old, $1 million, basically the average inefficiency in their portfolio, adding in taxes and everything else, was only 1.5% per year. It wasn't a big number, but over the period of 30 years, that added up to, if by eliminating that inefficiency, there's $2.6 million more money projected at age 90 by having a coordinated, efficient plan as opposed to not. And I got news for you. That's probably 25 years of the money they would have withdrawn from their portfolio for income. So imagine throwing away 25 years of income, and more importantly, throwing away that legacy value when you did not have to. You forfeited monies you didn't have to.
Yeah.
So that's the thing about efficiency in retirement.
Yeah, yeah, and, there's a lot to watch out for. I mean, yeah, the BlackRock thing, I read a little bit about it, and basically, they won't let people cash out of that $26 billion fund, that they have. They have a $26 billion fund, and they're not
And
letting people cash out of it, and, they're saying that should worry everyone. So,
it,
yeah.
it, yeah, absolutely.
Yeah, that's
Because,
weird.
because I'm sure people felt, it like a mutual fund, it's liquid. You've got to make the consumer whole. And
Yeah.
yeah, but when we talk about this, and this is what really surprises people. They're saying, "Oh, so that $2.6 million, but that's you're talking about the markets went south and really tanked for these people." No, this is not because the markets failed.
No,
It's
actually,
because
BlackRock stock went up when the Iran thing started. So
yeah,
briefly, so
yeah,
I know it went up at one point. BlackRock was up. That it has nothing to do with that, but it'll
yeah.
affect private lend. There's something called private lending that it affects, right? I mean, that's going to affect that. But yeah, that's a $26 billion fund that they're not letting people pull money out of. That's weird.
Yeah,
It's not good. So,
crazy.
yeah, it is crazy. But yeah, we'll have to do some more research on that. Maybe we'll have a whole show on what's going on and how that might affect some people. But talking about these things that are going on in the world and how they can affect us, especially in retirement. I know you have something called the Elite Wealth Structural Review. And listeners can discover their own structural opportunities. Maybe explain that. What's that all about?
Well, the structural review is this, and I think this is something we haven't done this for a long time on the show, and I think it's probably a good time to kind of take a breath and pause and think about this.
Sure.
And it's this. So if you're out there listening, you know, I want you to in your own head answer these questions. And if the answer to any of these is no, you should make a phone call. You should have a
Hmm.
communication. You should have a conversation with us. Start the conversation because there's very likely opportunity that you're not taking advantage of. So the first one, do you know your lifetime tax trajectory? So do you
Right.
know, have you ever seen the estimated tax cost over the next 20 or 30 years in your retirement? What's that total bill look like? Knowing what the tax rates are, knowing your situation, knowing what your expected income is, and I know for a fact that very, very few people have ever seen that because, Wall Street, the insurance companies, the banks all say the same thing. We do not provide tax advice, so they don't show it to you. So if you don't know that lifetime tax trajectory, then there's no way for you to realize what opportunity there is to save money in that arena with smart, advanced, future looking tax planning. So if you don't know that, give us a call, 888-888-5601, or visit Discover Unlock. Do you know the sequence risk exposure in your plan? So if the market looking into the future, because we don't know how deep the dive is going to go, we don't know how long it's going to last, but do you know what that exposure is? Can you actually divvy up, portions of your portfolio and not just say I'm in the stock market over here, I'm in the bond market over here, but of the $1 million that we have set aside in our 401ks, IRAs, whatever the case may be, we know that if the market goes south, that this $400,000 cannot lose one dime due to market movement. This $200,000 over here, we won't lose any money unless the market goes down more than 15 or 20% or whatever. So those are wealth protection, wealth preservation strategies. And that's the deer in the headlights look whenever we ask somebody, do you know your sequence risk exposure? Do you understand the level of wealth protection or preservation? And they're like, what's that? I never heard of it. So if you don't know that, you should give us a call. Let's start the conversation. Have you modeled your retirement withdrawals across tax buckets? So when you look at the withdrawals from your plan, both ones that you're taking or the forced ones, which will occur with RMDs, do you understand what that tax impact looks like? And not just in the form of taxes, but in the form of possibly higher Medicare costs, which is an expense, which is a drain on your wealth. If you haven't had that modeled, if you haven't looked at that, if that's not part of an actual plan, a living, breathing plan for you, then you should give us a call. And then finally, is your legacy strategy coordinated with your income plan? This is
Yeah.
a big one. As people, first of all, let's be candid. None of us want to talk about dying. None of us want to admit we're mortal. None of us want to admit that we're going to shove off this mortal coil one of these days. It's an uncomfortable discussion. But the simple fact is that, we have that discussion with you because you worked hard all your life to accumulate the nest egg you have. And, you should understand not just that tax trajectory while you're alive, and what's that tax trajectory look like for a surviving spouse when one of you is gone, but what does that tax trajectory look like? How much of money is going to go to Uncle Sam that may not be mandatory, that you could have had smart tax planning to reduce or even eliminate that because it's your money, you worked hard for it. You want you, your spouse, and your family to benefit from that money. I
Yeah.
don't think it's your goal to give it all to Uncle Sam.
No,
So
no.
that's
He's
that
not even my real Uncle Bill. Or Bruce, I've told you that he's not my
Bill.
uncle.
I'm not
Uncle
Bill.
Bill. I was thinking of my Uncle Bill. No, Uncle Sam is not my
Uncle
real
will
uncle.
send you a tax bill.
That's it. Uncle Sam will send you a tax bill.
Yep,
Exactly.
yep.
But that's important to note because again, this is something people don't take into account. They really miss out here, and that's why you need to, if you can't answer these questions, you need a structural review. What's your wealth structure? Do you have a written plan? Have you had reports run based on your personal situation and your time horizon, not your neighbors, not your relatives, not your best buddies, not a coworker, your own situation? And you can, that way you'll see your current trajectory, right? You can coordinate a retirement model that takes into account all the different factors you've been talking about. That's the
Oh my
goal, isn't it?
Yeah, and I'll put an alert out there. Here's one. This is what happens when you've been doing this for 40 years. So, ladies and gentlemen, do-it-yourselfers. um, I had a gentleman who was a client of ours for a while. He was a do-it-yourselfer. He was a client of ours for a while, and he's like, "Hey, I'm going to take over and manage this again myself." Okay, fine, no problem. And like a couple years went by, and there was a deep dive in the market. And I ran into him in the grocery store one day, and he said, "Hey, Bruce," he said, could you sit down and take a look at my stuff for me?" And I'm like, "Sure." I said, "Anytime, no problem." So he comes into the office, no joke, with a big, if you remember these, a paper shopping bag filled with 14 months worth of statements, unopened,
Oh,
unopened. And I'm like, "What is this?" And he said, "I can't look. I just can't look." And I'm like, "What are you talking about?" I mean, you need to know what's going on and make choices. And he says, he just froze. He went from 1,400,000 to 600 grand because
wow.
he wouldn't open the envelope. He didn't want to he didn't want to see the bad news. The fact of the matter is that don't be frozen in position, and don't sign up for, well, don't worry, it'll come back. It comes back a lot easier when you're working and you're contributing and your employer's contributing. It's going to take a lot longer to come back, and you're going to be the biggest problem because you're taking money out that's not going to be there to grow in the form of income. So it really, this is where a second opinion really comes in to play, and you want that to happen not after you've lost $800,000. Now's the time to say what can be done to continue and have good growth opportunities as the market does recover, or if it recovers, or when it recovers. But what can I do now to have wealth protection and preservation built into the portfolio? So do-it-yourselfers, typically they're at Vanguard or Fidelity or Schwab or wherever, and they're had products put in front of them, these mutual funds, and they all, they all know the track record. We all see the Morningstar reports. Yep, that's fine. That's average return. But they're not really exposed to wealth preservation and wealth strategies that are part of the coordinated approach that we utilize. So
Right.
being efficient, and don't get caught in a frozen position like we've seen some people do, and then
Yeah.
unfortunately they come to us, I'm not gonna say too late, but certainly more damage done than necessary.
Yeah. Yeah. And yeah, you don't want to do it too late. You want to get this in done. And that's why people need to work with somebody like yourself, a trusted financial services professional. And you guys have been doing this at Wealthcare for a long time, and you've got all those professionals there under one roof, a great team to help people with all aspects of this, correct?
Yeah, I mean, my son Bruce, I always say, he's a Penn State grad. I told him do anything but this, and he said, "No, Dad, this is what I want to do." No, I did. I really did. I tried hard to push him away. Let him make his own way in life, and don't do what Dad did. Because the negative has been, and someday maybe he'll watch this on YouTube and he'll hear me say this, but I'm hard. I'm hard on people. I push them to always be better because I think people can be better than they think they can, and
Mhm.
and I've always pushed him, and I've always pushed Chris, our on staff
Yep.
CFP, and Chris has been coming around my house since 4th grade, so he's about as close to a son as I have. Um, and we
That's
have
awesome.
2 great boys, Vaughn and Bruce. But Bruce has been there 20 years. Chris has been there 20 years. These guys were high school buddies growing up. Um, but I will put them up against 98% of the advisors in this country. And I've said that for a long time, but now we go to these elite wealth events with top level advisors, and it's funny that I can just kind of like fade into the background a little bit and watch them, and I can watch the circle of other advisors build around them as they talk about elite wealth strategies and what we do. And they're like, well, how do you do this? How do you do that? How do you do it? So they're sharing, but they're also the driver of a lot of these things. Um, and the thing is, when people sit down with us, they find out that what we talk about on the radio, what we talk about in seminars, what we've talked about on TV when we were doing TV, what we talk about in our digital campaigns is we are what we say we are. And we're
Hmm.
going, and we don't know if we can help you. We don't know. I mean, it starts with a clean sheet of paper and a conversation. And, if we see opportunity, we say, here's an opportunity we see. We explain it in simple terms, and that's what people are looking for. They're like, you're looking for structure. They're looking for, I have a great advisor, and that's not a question. I think there's phenomenal advisors, but are they people that function at this level? Do they have the tools, the technology, the experience for a coordinated wealth management strategy, not just portfolio management? And if you're saying, do I have it all, or am I just kind of running on 2 cylinders instead of all 8? Pick up the phone and give us a call. You have that elite wealth discovery call with us at 888-888-5601. Tony's favorite number, 888-888-5601, or visit discoverunlock.com. And we
Yeah.
saw a lot of people on discoverunlock.com last week, by the way. So
Yeah.
that's always a good thing. So thank you, listeners.
Yes, exactly. And I know you love hearing from them as well, listeners and viewers. And so basically, what you're saying is there are a lot of different aspects. There's a risk strategy, portfolio strategy, tax strategy, income planning, retirement income, legacy planning, tax planning. And so many people like you, to use your term, have these siloed, or maybe they don't even have them all covered, even healthcare planning. But when those strategies are synchronized and coordinated, like you say, that's the difference, right? That improves a lot. That improves efficiency, sustainability, right?
Yeah, it's the opposite of what the financial industry does. The financial industry is everything, all the marketing is predicated on one thing, finding your hot button. And when they
Right.
find that hot button, they just keep pushing it. Okay, if you're risk averse, hey, we've got a solution for risk averse people, and they keep pushing the button. If taxes are your hot button, oh, we got a great tax strategy for you. If legacy, I don't want to leave it all to Uncle Sam. Okay, we keep pinging on that. Income, okay, fine. Here's an income product. Buy a product, we'll solve all your needs. And the fact is, they're just all one-legged. I mean, you can have a four-legged stool or a one-legged stool, and which one is the most stable? Which one is the most predictable? Which one can you feel safe in sitting in? And that's the name of the game. So coordinating all four of those, and sometimes people have fragmented. They have an annuity person that they bought an annuity from one time and they never hear from ever again. They have a portfolio person that gives them performance reports, but that person is never going to make them money or lose them money. It's where their money is invested. And so in most of those times they don't have wealth protection or preservation built in. The tax person for most people is TurboTax or freetax.com, or maybe a tax preparer at H&R Block, or maybe a CPA. but it's a one-time type thing. That's not tax planning. That's not retirement forward-looking tax strategizing. That's just a tax return preparation. It's a different animal. And then, legacy planning, my God, the number of people that don't even have wills and powers of
Oh,
attorney.
yeah. Yeah.
It's and in today's world, I mean, that there's no reason for that because it's pretty simple to make that happen, and we have a system for that for our clients now that they can basically fill in all the pieces at their end and generate those documents and go get them notarized, and you're good to go because that's what's happening with AI. That's what's happening with softwares. Is there's a lot of things out there where and I have lots of friends that are attorneys, and I'm not trying to pick on attorneys, but an attorney sits down with you, you pour your heart out to them about your family, and this is where I want my money to go when I'm gone. And then what do? They take the notes and they hand it to the person in the next room. They enter it into a piece of software and it goes zip, 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 and it prints out. And they say, hey, here's your will. Hey, here's your power of attorney. Well, the technology world has bypassed that and said, look, we want something that's 50 states valid, or 49 states, I think, for the case of willmaker.com or whatever.
Sure.
But you can have those documents, but the documents is not legacy planning. That's just
No.
I have documents to facilitate things if I die or if I
Mhm.
take
And you
ill
need
or
those. Those are very
you
important.
need those. They should be
Yeah.
part of the program. But the legacy planning is saying again, what is that? What's that bill look like? What's it going to cost? And here's one that really we've got a lot of second generation clients from this because we talk about what as far as your children, they're going to inherit retirement money, and here's the tax impact to them. And and like how old is your son or daughter? Well, they're 50. I say okay, and you figure you've got another 15 years left. Okay, so they're going to be how old? 65. So right at the time they're getting to retire, they're going to inherit retirement accounts that they're going to be forced to take distributions from, and you're talking about really elevating them with regard to IRMA, elevating them into a higher tax bracket, meaning more of your capital will be lost due to no intergenerational planning. And then the son or daughter, a lot of time, we just picked up a gentleman in Texas for the same reason, and he's like, I'm so glad you talked to my dad about this because man, that would have totally tanked my retirement. So
Yeah.
if your parents have a significant retirement, um, give us a call, start the conversation, and let's sit down as a group, and discuss the tax issue.
Yeah.
Because this is probably the main area that we hear the words "I never knew," and knowledge is power, and knowledge is value,
Yeah.
and that's our key element in what we provide to our clients at WealthCare.
Yeah, that's huge. Well, we're out of time, Bruce, but you brought a lot of great information to the show today, a lot for our listeners and viewers to think about. Once again, tell us about that. You're offering a 20-minute consultation, discovery call, right?
Yep, to find out about our coordinated elite wealth plan, give us a call today at 888-888-5601. Again, Tony's favorite number, 888-888-5601, or visit us online, discoverunlock.com. And we look forward to talking to you guys soon. Have a great week.
All right, that does it for today's episode of Unlock Your Retirement with our host, Bruce Smith.